Hello number-curious friends, welcome to the channel where we talk accounting and finance. Today we unpack factoring, how a business turns invoices into cash faster. You will learn what factoring is, why companies use it, main types, clean journal entries and the impact on KPIs like days sales outstanding. We will use our Apple shop as the running example. So what is factoring? Factoring means you sell or pledge your accounts receivable to a finance company called a factor. In return, you get cash now minus a fee and often a holdback which the factor keeps as a reserve. The factor then collects cash from your customers. Reasons for factoring are simple: speed up cash receipts, reduce collection work, smooth seasonality, lower credit risk if the factor takes it, and sometimes improve ratios like days of sales outstanding. The trade-off is cost, fees and interest, and sometimes you can still carry the credit risk. And before we dive in accounting, a few key terms to unlock the topic. The first one is advance rate. This is the percent of the invoice that the factor pays upfront, for example 80%. Holdback or reserve, the part the factor keeps until the customer pays, used to cover disputes and fees. Recourse and non-recourse factoring, also called with recourse and without recourse. Recourse means you still take the credit loss if the customer doesn't pay. Non-recourse means the factor takes all risks. Notification and non-notification factoring. In notified deals, the customer is told to pay the factor. In non-notification, the customer pays you, while the factor sits behind the scenes. The money is then transferred to a factor later. Typical steps for the factoring include: 1. You deliver goods and issue an invoice. 2. You sell the invoice to the factor. 3. The factor advances cash, for example 80%, and keeps a reserve. 4. The factor collects from the customer. 5. The factor releases the reserve minus fees. Factoring often works as a roll-in program with continuous transfer of receivables to the factor up to a certain approved limit. Sometimes, factor can specifically indicate the list of customers from whom he will accept invoices. This would usually include the most reliable customers. And when it comes to accounting asks one key question: did you transfer the receivables and transfer the risks and rewards or control? If yes, you have a sale and you derecognize the receivable. If not, for example you keep most of the credit risk, it is usually a secured borrowing. You keep the receivable and record a loan payable. Let's get to our Apple shop and see how it works in practice. Imagine we have sold $20,000 worth of apples to many different customers. Our journal entry would be: debit accounts receivable 20,000, credit sales revenue 20,000. Now we decide we want our cash earlier and sell 10,000 of the receivables to a factor. Let's first look at non-recourse factoring, where we completely transfer the receivables and don't retain any collection risk. Meaning, if the customer doesn't pay, the factor company will take the losses. Here, the factor takes the credit risk, so this is a sale, and such factoring will be more expensive than a recourse one. Let's have a look at a simple example. The factor accepts our 10,000 of receivables at a fee of 5%, so we get 9,500 in cash. $500 will be our expense for factoring. And the journal entries would be: debit cash 9,500, debit factoring fee 500 to reflect the cost of factoring. Sometimes this can be called loss on derecognition of receivables. Credit accounts receivable 10,000. And in a T accounts world it will look like this. Often, you would keep a separate sub-account on the balance sheet for factored receivables within trade receivables, to track the amounts and have a clear view of how much you have transferred. In this case, you would credit that sub-account and it will look like this on the balance sheet. In this case, when you do regular reconciliations with the factor, you will remove those amounts from the balance sheet for payments received by factor. Debit factored receivables 10,000, credit accounts receivable 10,000. Just a reclassification, net receivables don't change. Now we introduce a complication. The factor pays us 80% now, keeps 20% as a holdback, and charges a 3% fee on the invoice when the customer pays. So now we receive only $8,000 in cash. Debit cash $8,000. Debit due from factor holdback receivable $2,000. Credit accounts receivable $10,000. Then, when a customer pays, we owe $300 to the factor. Debit factoring fee expense $300. Credit due from factor holdback receivable $300. Now, the receivable from factor holdback will decrease by $300 from $2,000 to $1,700. We will not pay factor, but we will receive less cash as final settlement. When all customers paid, the factor releases the reserve. Debit cash $1,700, credit due from factor holdback $1,700. So, for non-recourse factoring, we derecognize the receivable. We show cash for the advance. We show a due from factor for the holdback. We expense the fee if it is earned at transfer, or accrue it if it will be taken from the holdback. And before we move forward to the recourse factoring, if you find our lesson useful, please take a moment to hit a like button and subscribe to our channel. Your support is very important to us. Now let's have a look at the recourse factoring, where we are taking the full risk if the customers do not pay. In this case, the factor will claim the uncollected amounts from us or sell back the uncollected receivables. The factor advances 80% against the same $10,000 invoice and charges monthly interest until collection. That looks like a secured borrowing, so we reflect it as a loan. And the receivables stay on the balance sheet, no derecognition. Journal entries will be: debit cash $8,000, credit loan payable $8,000. Each month we accrue the factor's interest, let's say $100. Debit interest expense $100, credit interest payable $100. When the customer pays the factor, we recorded the following way. Debit loan payable $8,000, we settled our obligation to the factor. Debit cash $2,000, the factor pays us the rest of $10,000. Credit accounts receivable $10,000. And yes, we need to pay interest. Debit interest payable $100, credit cash $100. Alternatively, the factor could have paid us not $2,000, but the net amount excluding the interest fee, $1,900. In another scenario, the customers could have paid us, not the factor. Then we would book it as follows. Debit cash $10,000, credit accounts receivable $10,000, and transfer the cash to the factor. Debit loan payable $8,000, credit cash $8,000. The result of recourse factoring, accounts receivable stayed on the balance sheet and we showed a loan until repayment. There is, however, another possible scenario for recourse factoring, where the losses you assume are kept. And based on the accounting principles, you can still derecognize the receivables, but create an estimated liability for non-payment from customers. Let's sell $10,000 of receivables at the fee of $500 and estimate our potential losses at $50. The journal entries will be: debit cash $9,500, debit loss on derecognition in P&L $550. This will be the fee of $500 and $50 of estimated credit losses. Credit accounts receivable $10,000. We remove all sold receivables. Credit recourse liability or retained credit risk $50. If the customer pays, the reserve is released and the recourse liability is reversed to income. Debit recourse liability $50, credit other income $50. Your final gain or loss depends on collections. So, here are 3 practical signals to check for the recognition of receivables. Credit risk. Who takes the loss if the customer never pays? Control. Can the factor freely sell or pledge the receivables without your say? Calls and guarantees. Do you give a guarantee to make the factor whole beyond normal price adjustments? If the factor takes the credit risk and controls the asset, it is often a sale. If you keep the risk through recourse or guarantees, it is often a loan. What are the effects of factoring? Factoring can change the optics of the financials. It may result in lower days of sales outstanding if it is a true sale, as receivables drop but revenue is still the same. Change in leverage. A sale does not add debt, a borrowing adds a loan payable. Operating versus financing cash flow. Proceeds from a true sale are usually operating cash flow because they replace collections. Proceeds from a loan are financing cash flow. And factoring is not for free. Do not just read the fee percent. Convert it to an annualized cost. For example, a fee is 2% per 30 days. If customers pay in 45 days, cost is roughly 3% for 45 days. And an annualized interest would be 3% times 365 days divided by 45 days equals approximately 24%. And there are a few more flavors to factoring. Maturity factoring. The factor pays you the remaining balance on a fixed date, even if the customer has not paid, then collects later. Invoice discounting, a similar cash advance, but you keep collections and repay the factor quietly. Reverse factoring or supplier finance. Your suppliers sell the invoices to a bank based on your credit rating, and you pay the factor, not your supplier. This is about payables, not receivables. So, what are the common mistakes to avoid? Do not derecognize accounts receivable if you still bear the credit risk through recourse or guarantees. Do not forget the holdback asset. Do not net factoring fees against revenue. Show them as financing or other expenses per your policy. Okay, it was quite a complicated topic for today. Let's summarize the lesson. Factoring turns invoices into cash faster. Decide accounting by asking, did risk and control pass? If yes, sale and derecognize. If not, it is a loan secured by receivables. Record advances, fees, interest and holdbacks correctly. Watch out for DSO, leverage and the cash flow line. Reconcile the factors statements to your ledger monthly. That is factoring in plain language. Hope it helped understand the topic a bit better. Thank you for watching. If you enjoyed this lesson, hit like, subscribe and ring the bell so that you don't miss the next lesson. See you soon and keep those debits equal to your credits.